Welcome to CFP Exam Prep. Today we're diving into a critical topic that often appears on the exam: bankruptcy reporting requirements for CFP professionals. This seemingly straightforward topic actually contains several nuanced elements that candidates frequently misunderstand. Let's break down the fundamental requirement. CFP professionals must report personal bankruptcies that occurred within the past 7 years to both the CFP Board and their clients. The 7-year period starts from the date of discharge or dismissal, not from the filing date. Many candidates make the mistake of counting from the filing date, which can lead to incorrect answers on the exam. The reporting process has specific timelines that you need to memorize. When it comes to the CFP Board, professionals must disclose their bankruptcy within 30 calendar days of the occurrence. For clients, the disclosure must happen before any professional engagement begins. If the bankruptcy occurs during an existing client relationship, the CFP professional must inform the client within 90 days of the bankruptcy filing. Here's a practical example that often appears in exam questions. Imagine a CFP professional filed for bankruptcy in January 2020, and it was discharged in June 2020. They must report this bankruptcy until June 2027, 7 years from the discharge date. If they take on a new client in 2025, they must disclose this bankruptcy before beginning the engagement. A common trap question on the exam involves business bankruptcies. The reporting requirement applies only to personal bankruptcies. Business bankruptcies, where the CFP professional isn't personally liable, don't need to be reported. However, if the professional is personally liable in a business bankruptcy, it must be reported following the same rules as personal bankruptcies. Another frequently tested aspect is the disclosure method. The CFP Board requires written notification through their online reporting system. For clients, while written disclosure is strongly recommended, verbal disclosure is technically acceptable. However, the professional should document when and how the disclosure was made. Here's where candidates often lose points. The exam might present scenarios where multiple events occur simultaneously. For instance, if a CFP professional files for bankruptcy and takes on new clients during the same period, they need to manage both the 30-day CFP Board reporting deadline and the pre-engagement client disclosure requirement. The bankruptcy reporting requirement serves two essential purposes. First, it helps maintain transparency and trust in the financial planning profession. Second, it allows clients to make informed decisions about their professional relationships. The CFP Board takes this requirement seriously, and violations can result in disciplinary action. Let's address one final misconception. Some candidates believe that if a bankruptcy occurred before obtaining the CFP certification, it doesn't need to be reported. This is incorrect. Any bankruptcy within the 7-year look-back period must be reported, regardless of when the individual became a CFP professional. Remember these key points: 7 years from discharge or dismissal, 30 days for board reporting, pre-engagement disclosure for new clients, 90 days for existing clients, personal bankruptcies only unless personally liable in business bankruptcy. Written documentation is always best practice. This topic frequently appears in questions involving professional conduct and obligations, so ensure you understand these timelines and requirements thoroughly.